2010 concluded with end-of-year stock market levels, which would have been a surprise probably a year ago. As we know, the riskier assets performed best, such as private equity, commodities, emerging markets, and the lowest returns came from cash, obviously, absolute returns, global bonds, and fixed interest. We also had the European sovereign debt crisis, which is still unresolved, and at the beginning, we're at the beginning of QE2, certainly as far as the US is concerned. So I'd like to ask you some questions about 2011 and what you think we may have to look forward to.
Well, I think, although it's tempting just to look at 1 year at a time, I think markets discount over several years. So in looking at 2011, like any year, the big question people have to ask is, should I be looking to preserve capital or should I be looking to accumulate capital? But the problem is that we had a very good 2010, and whereas people are quite used to actually seeing all markets fall in a crisis, it's actually very unusual to have all markets rise at the same time as they did in 2010. So we're going into the new year with a degree of optimism, a positive momentum in markets, and I think one has to be a little bit careful about that, because we know that interest rates, if you allow for inflation, are negative, so accumulating capital out of income is impossible. We've seen house prices fall, arguably they're going to fall further, and we've seen bond prices start to fall, having had a very good 25-year run. So I think that the balance between capital preservation and capital accumulation will actually, as the year unfolds, move in terms of capital preservation mode. We know that there's an austerity programme being enacted, not least in the UK, but particularly large in the UK. And we know that as we go through the year, the markets are going to say to themselves, well, if the recovery continues, and at some stage interest rates are going to rise, and we're going to start seeing the brakes come on. So I think that one needs to actually have a degree of risk control. Don't get carried away with the positive momentum at the beginning of the year, and just remember that as we go into 2012 and 13, this austerity programme is going to continue. So I'm very much in capital preservation mode rather than wanting to actually take lots of risk.
I understand. Much has been made in the press of the significance of global emerging markets and their impact on the global economy. What is your take on the importance of global emerging markets to the global economy in 2011 and beyond?
Well, emerging markets are the great hope for the recovery to come, because everybody now knows that the China, the Indias, the Russias, Indonesia, Turkey, all these new economies are going to overtake the Western economies over the medium term. So it's not so surprising that these are very fashionable areas. But because so much money has come their way, they're having to fight inflation. There's much more of an inflation problem in these developing countries than there is in the Western ones. And when you have an inflation problem, even if you have economic growth, by and large you find that markets do not get re-rated. Markets do not like inflation. They quite like growth, and they quite like low inflation, but they don't like inflation that's out of control. So as the brakes come on to control it, and incidentally, though China is everybody's hot topic, actually the Chinese market did not perform well in 2010. So I think the relevant approach for emerging markets is to actually invest in those things that are affecting the world economy. So for example, commodity prices, agricultural trends, infrastructure stories, obviously the Chinese consumer, the global consumer from the emerging areas are being met by companies in the West more than companies in their local countries. So I think there are ways that you can play the emerging story without necessarily having to invest directly in those economies. And I think that will be particularly relevant for this coming year.
2010 also saw a number of downgrades in national sovereign debt ratings. If government debt is no longer deemed to be as secure as it has been pretty much always in the past, what do you believe now constitutes a low-risk investment?
Well, that's a key question actually for many investors, because they use government bonds, and particularly low-risk government bonds, as the basis for valuations. Now, it's not fair to say that all governments are in a mess. There are, in Scandinavia, the Swiss government does not have the level of debts that we are experiencing in the UK or indeed throughout Europe and the States. And so there are governments that you can regard as still core holdings, but equally, and perhaps surprisingly, there are now increasingly more AAA companies than there are AAA governments. And so I think that people investing in some of the major AAA corporates will regard those as a reasonable proxy for the low-risk investments they had in governments in the past. But the other thing to note here is that when you're faced with this sort of change in the risk bank ratings, it's also important when you choose funds that you choose fund managers who themselves have defensive qualities. If the world was a different place, and indeed through the 80s and 90s, you were being paid to take a lot of risk. It was a golden period for share investors and for bond investors. We're not there now. You actually have to have a more defensive tone to it. So not just in terms of the structure of the portfolios to keep the risk under control, but the selection of funds within those portfolios should emphasise the guys who are more defensive in their choice of stocks and their approach. Because I think the combination of the two is appropriate, where you've got changes in the risk ratings of major investments.
Which really means that the fund managers have had a consistent approach to their particular style of investing and haven't been persuaded to change that as market conditions have changed along the way.
Yes, but you have three types of investors. You have the guys who are always wanting to put risk on, you have the guys who are naturally defensive, they're usually called value investors, and you have some who try to switch from one to the other, not always very successfully. In this environment, I think the emphasis on the value investors, the more defensive guys, is appropriate.
Okay, well thank you ever so much for that. Perhaps we can have another chat sort of part way through the year and we can see how it's beginning to pan out.
Okay.
Thank you very much, Michael.